The US dollar declined for the second consecutive session yesterday, allowing a positive feedback loop into the major US stock indices that rose for the second consecutive session since Monday. And that also came in line with a tepid price action movement in the West Texas crude oil as it continues to trade in a tight sideways range below this Monday high. Good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be the Wednesday, the 18th of March, 2026. So as usual, let's have a quick look at the disclaimer first before we kickstart the gist of today's Daily Dose. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so let's have a quick recap what has taken shape yesterday in terms of the relevant news flow and their impact on the various respective broad-based cross-asset classes. So yesterday, what we could see over here is that the West Texas crude oil. Give me a minute, let me share with you the screen. So hopefully the screen is good. All right. Okay, great. So let me share with you the chart of the West Texas crude oil over here. Right, so this is the daily chart of the West Texas crude oil. So what we could see is that, oops. Over here, this is Monday's bearish engulfing candlestick on the West Texas crude oil, where it inched down negative 4.32%. And yesterday, price movement traded in a sideways range over here. Yes, it's up by positive 2.26%, but it can't break above Monday's high over here. So that actually explained to us why the dollar weakened and the major US stock indices continues to rally in line with other Asia Pacific stock market as well. So the key thing is, what is the main driver in the global, we call it global macro space, or in the broader base global markets, is all now lie on the movement of oil in relation with this ongoing US-Iran war conflict that put away that increase the odds of stagflation fear, the risk of stagflation fear, and that can be expressed in the price movement of the oil prices. So as long as oil prices remains muted on the intraday basis, potentially we could see further weakening of the US dollar, then that actually translate to a further positive feedback loop in the very near term for the major US stock indices, and in some form the other global major benchmark stock indices for the rest of the other region as well over here. All right, so with that, let me now take you through the movement of the FX market. So what I could see is that the FX market yesterday also dipped down over here. The dollar weakened across the board. So this is the 5-day rolling performance of the US dollar against other major currency together with the Euro Swiss cross pair over here. So yesterday, we have one major central bank, well, not really major, a developed central bank monetary policy meeting. And this central bank is nevertheless RBA, because very important. RBA is the first central bank that kickstart a interest rate hike cycle this year. Not cut, a hike cycle. That is doesn't take into account of the Bank of Japan, which is a bit of an outlier because there has been a ultra dove central bank since 3 to 4 years ago. So let's take a look at the stances of RBA. So RBA yesterday hiked as expected. So they introduced the back-to-back, we call it interest rate hike for the very first time since, give me a minute, I think since 2023 or so, something like that. Yeah, back-to-back hike since 2023 over here. So they hiked the policy cash rate to by 25 basis points from 4.1% to 3.85%, from 3.85% previously. So RBA Governor Bullock, she was very hawkish in terms of a press conference. So she talked tough on inflation expectation during a press conference yesterday, repeatedly saying that prices remain too high, and the RBA board of governor was RBA board, which was worried about second round effects from higher energy costs triggered by the Middle East conflict over here. And right now, short-term interest rate market traders are now starting to price in higher than 50% chance, almost 60% chance that a follow-up hike will be in May. All right, so market participants in the short-term interest rate market in Australia is not looking for RBA to pause anytime soon. And in fact, they could extend their interest rate hike cycle going forward in May and even into the later part of this year in Q3 over here. So what I could see is that they are pretty much worried about this inflation trend in Australia over here. So what we could see is that Australia, the one is in black, all right? So very clearly, since late last year, it starts to do a V-shaped recovery in terms of inflation trend, and the rate of growth is much more higher in US and versus UK. That is being depicted in bright pink and the blue line over here. And persistently now, the current Australia, what calls the CPI data for Australia for the latest month of January is up by 3.4% year on year. That's way above the upper limit of 3% inflation target that RBA desired. So what we could see yesterday is that the Australia dollar came in with our expectation. So for those who follow our daily dose yesterday, we do have a bullish bias yesterday, where the Australia dollar continues to hold firmly above the key Titan short-term support at 70.15, 7015. And in today's Asia session, it almost hit our first resistance zone, which is 7120/7140 level. So I'll touch more about that when I cover the short-term intraday outlook for the FX markets. And going into the US market, so over here, the US market rather choppy yesterday, but we managed to see positive gain across the board for the four major US stock indices. The SPX is up by 0.25%, the Nasdaq 0.51%, the Dow Jones up by 0.10%, the Russell 2000 up by 0.67% over here. 0.67%, pardon me. And if you look at the E-mini futures that is trading right now during the Asia session as we are speaking, 11 a.m. Singapore time, the S&P E-mini futures is continuing to extend their gain from yesterday US session, up by 0.27% and trading near the session high at around 6,790. Very similar for the Nasdaq 100 E-mini futures that is trading right now during the Asia session. As we are speaking right now, 11 a.m. Singapore time, up by 0.39%, also trading close to the session high at 25,114. So what we could see right now very clearly is oil prices remain subdued, leading to a weaker US dollar, then therefore creating a positive feedback loop into the US stock indices. And that in turn also right now seeing a positive feedback loop in most of the Asia Pacific benchmark stock index as we are speaking. So the Nikkei 225, as we are speaking right now, the cash market is up 2.23%, also trading at the session high, 54,898. The Nikkei 225 futures contract that is taking into account of the US session yesterday up by 1.08%, also trading at the session high, 54,800. And the one that is the outlier will be the Hang Seng indices, down slightly, negative 0.2% over here. That's in line with the China A shares market. The CSI 300 is down by negative 0.6%, trading near the session low right now. Very similar to the smaller, narrower China A50, which is comprises only of the blue chips in the Shanghai Stock Exchange, whereas the CSI 300 consists the blue chips of a broader base of subset of the A-shares market, both Shanghai and Shenzhen stock markets. So the smaller China A50 also down by negative 0.57%, also trading near the session low. If you look at across the other Asia Pacific market, all of them are in the green. The ASX 200 up by 0.21%, trading near the session high. The KOSPI is up by a whopping 4%, trading at the session high as well. And Singapore STI is also up by 0.9% at 4,982, pardon me, trading near the session high. So what we could see is right now, as we are speaking on the very short-term basis, kind of a risk-on environment in general, with the exception of the Hong Kong and China stock market. All right, so over to this US-Iran conflict. There right now, today will be the 19th day. If you take into account of today's 19th day, so there is no sign of de-escalation. So right now, it seems to us that the US is in need of help to get traditional US airlines and partner to help ease the burden by we could put it in a way that by asking various countries like Germany, Japan, and some of the European countries like France to actually help to send their respective military warships to open up the Strait of Hormuz. So apparently, help is pretty much lackluster, saying that most of the airlines are openly rejected his appeal, and both sides, US and Israel, keep up their attacks on Iran, and Israel saying that it had killed a key appointment holder in Iran, which is Iranian security chief Ali Larijani, in an overnight operation over here. So far, both sides are what you call it, shooting we call it missiles and bombs against each other. So and right now, US President Trump continues to threaten that he will expand airstrikes on the Kang Island. So Kang Island itself is a very important coastal, we call it energy export hub of Iran, which is the Iranians' main export hub. So if Trump were to actually expand strikes on Kang Island, so far Kang Island strikes targeted by US is non-Iranian oil assets. So if Trump were indeed bomb Iranians' oil asset, that could actually potentially lead to a spike up in oil prices from a short-term speculative point of view. All right, so things are still pretty much fluid right now. So what we could see right now in the market movement, which I explained to you guys earlier, is more like a relief rally or relief breather for the oil prices to do a minor setback. So the overall medium-term uptrend of oil prices still remains intact, which means that the dollar eventually could strengthen further, and that could create another round of negative feedback loop on the global stock indices. So right now, we are taking one step at a time, looking at key levels to maintain those very short-term intraday trend bias view. All right, so that sum up the first segment of the daily dose. So let us now move on to the second segment, which is the key intraday technical outlook on those various broad-based cross asset classes, starting from the FX market. So bear in mind that today will be also we have a key risk event coming into play at 2 a.m. Singapore time later on the Thursday, 19th of March, which is the FOMC meeting. Later I'll touch more about that situation, all right, towards the end. So let me expand my screen so that you guys could have a better view of the charts. All right, so I think the chart is good. Okay, so let us start with the euro dollar first over here. So the euro dollar continues to stage that mean reversion rebound as expected, coming very close to the resistance level at 115.65. So with that, we will have a slightly adjusted upward pivotal support level, upper limit at this 114.80, lower limit 114.55. So using this pivotal support zone 114.80/114.55 to maintain this mean reversion rebound scenario on the euro dollar as it continues to extend further, potentially above 115.65 exposes 116.05 and maximum 116.73, which is the confluence between the key 200-day moving average and the 20-day moving average. However, a plunge down below 114.55, pardon me, a plunge down below 114.55 and an hourly close below it, that would continue its corrective decline phase on the euro dollar to expose the next near-term support level at 114 figure level, followed by 113.60, which is the minor swing low congestion area of 2nd of June and 4th of June last year. Okay, so that's for the euro dollar. still maintaining our short-term mean reversion rebound scenario using 114.80, 114.55 short-term pivotal support zone. All right, next will be the sterling pound. All right, over here. So the sterling pound also continues to inch higher, clearing above the first resistance level at around 133.40 that we have yesterday. So this 133.40, 133.30 will be my first intermediate support level. But so far, it hasn't breakout above this medium-term descending channel resistance that has been in play since the high of 28th of January this year, depicted in purple. So what we do is that we don't want to tighten the pivotal support so much. So we put a zone using yesterday's European session low, all right, yesterday's Asia session low, all right, at 132.60. So it will be a zone 132.85 / 132.60. Maintain this ongoing minor mean reversion rebound scenario that is still intact for the sterling dollar. First resistance level to watch for today will be the all-important 134 figure level, psychological level, upper limit of this medium-term descending channel, and as well as the minor swing high of 12th of March. Breaking above 134 figure level, we'll see a much more pronounced extension towards 134.50, maximum 135.05, which confluence with the 50-day moving average. Only a bearish breakdown below 132.60 will invalidate this mean reversion rebound scenario to revive the corrective decline phase to work back towards the lower limit of this medium-term descending channel, exposing the next near-term support level at 132.32, 131.80 level. Okay, that's for the sterling dollar. Next will be the Australia dollar over here. Let me expand my screen. Okay, so the Australia dollar did a push up towards 71.20 / 71.40, the first resistance zone that we highlighted yesterday, before it traded sideways as we are speaking right now over here. So net overall is now back above the 20-day moving average. All right, it's now trading back above the 20-day moving average at 70.75. So given that it hasn't cleared above 71.40 level, I do not want to tighten my short-term pivotal support level that we have yesterday to be at 70.75. So I'll be still using 70.15 as my short-term pivotal support, still maintain this ongoing bullish bias on the Aussie dollar above 71.40, potentially see a retest at 71.90, which is very close to the 11 of March 2026 high, and also the current year-to-date high as well. However, if price action starts to clear above 71.40, then I will tighten my pivotal support to 70.75. On the flip side, if you start to see coming down and breaking below 70.15, this bullish bias scenario will be invalidated to see a choppy downward move to revisit 69.80, maximum 69.44. So 69.80 is in fact the 50-day moving average and also the pullback line of this former minor descending resistance. Previously from 27th of February 2026 high, now turns into a pullback support, confluencing at 69.80 together with the 50-day moving average. Below it, seek out 69.44, which is the minor swing low of 3rd of March 2026. So that's for the Aussie dollar. Next will be the dollar yen. So the dollar yen traded sideways, still holding above yesterday's pivotal support at 158.60. But however, the RSI continues to print out a series of lower high, which is a kind of a bearish divergence previously as well. So indicating this lower high is the lack of upside momentum, and also we start to see a broad-based dollar weakness that is still intact, which I show you the chart of the euro dollar, the sterling dollar, and the Aussie dollar. I will be no convinced to maintain a bullish bias on the dollar yen like we have yesterday. So instead, I will flip to a neutrality stance for today, neutral between 159.68 and 158.60 for now. All right, so flipping to a neutrality stance between 158.60, 159.68 on the dollar yen. All right, next up will be the global stock indices. All right, let me expand the screen. Okay, starting with the Hong Kong 33 over here. Right, so the Hong Kong 33 can't break above the yesterday's high, and also that also coincides with the high of last Wednesday, 11th of March, and also the 20-day moving average, but still holding above this pivotal support that we have yesterday, which is this 200-day moving average at 25,640. So given this lackluster movement that is being expressed in the last 24 hours, I will flip to a neutrality stance for today on the Hong Kong 33. All right, on the intraday basis, given that it seems to me that there's no momentum right now flowing through based on the latest price action. So neutral, okay, let me change it. Okay, so neutral between 26,147 and 25,640. All right, so that's for the Hong Kong 33. Next will be the Japan 225 that is representing the Nikkei 225 over here. So the Japan 225 yesterday, we have a neutrality stance between 54,900 and 53,066. So what I could see right now is that the hourly RSI has started to print out a series of higher low. Okay, over here. Let me expand it. Okay, a series of higher low, and this higher low is moving at a higher, steeper slope compared to the previous higher low previously on 9th of March and 4th of March. So indicating that the price action on the hourly RSI in conjunction with the raw price action since the last Friday and yesterday's movement by a steeper higher low that is being seen on the hourly RSI, indicating that the bullish momentum has started to resurface on the Nikkei 225 or the Japan 225 CFD index. So with that, I will now have more confidence to flip to a bullish bias stance over here, indicating that there could be a break above this upper neutrality zone that we have yesterday at 54,900. So given that it hasn't broken above 54,900, I do not want to tighten my pivotal support to be so tight to yesterday's European session low, which is at 53,715. So using 53,066, which is a very important short-term support level where price action managed to help on last Friday and in today's and this week Monday Asia session. So short-term pivotal support for now will be at 53,066. Only an hourly close and a breakout above 54,900 that I will tighten it to 53,715. Above 54,900 exposes the next intermediate resistance level at 55,760, followed by 56,626, which also confluence with the 20-day moving average. However, a breakdown below 53,066 potentially invalidate this bullish recovery scenario and see another round of bearish down leg to retest last Monday swing low area at 51,055, which is the 9th of March swing low area. Next will be the Germany 30. So the Germany 30, yesterday we have a neutrality stand as well between 23,805 and 23,200 zone over here. So if you look at the hourly RSI, that also been pretty much bullish as well. Price action continues to remain above this key ascending trendline support, a series of higher low. And right now, what we could see at yesterday, price action broke above its former descending trendline resistance and did a retest during yesterday's US session over here. So indicating that some form of bullish momentum has started to resurface in the near term for the Germany 30 CFD index that's representing the German DAX. So with that, we will flip to a bullish bias. So but given that price action hasn't broken above 23,805, that was our upper range neutrality limit since Monday. I do not want to tighten my pivotal support to be so tight to 23,659, which was yesterday's pullback support that's being seen in the US session. So pivotal support for today will be at 23,280 unless we have a clearance with an hourly close during the European session at above 23,805. Then I will tighten it to 23,659 over here. Above 23,805, potentially seek out 24,162, which is the 200-day moving average, followed by the swing high area of 5th of March at 24,350 that confluence with the 20-day moving average. However, a price breakdown below 23,280 will invalidate this recovery scenario or this mean reversion rebound scenario on the Germany 30 to expose the next two near-term support level at 22,970 before the all-important 9th of March minor swing low area, which was last Monday at 22,680. 47. Right, so that's for the German 30. Next will be the US Wall Street 30. So the US Wall Street 30, yesterday it rallied and hit our first resistance level at 47,460, almost hitting it. That was a high of 47,429. All right, very close to it before it did a pullback, and right now during the Asia session is trying to stage a rebound over here. And what's interesting, the hourly RSI continues to flash out a series of higher low. All right, so with this positive observation on the hourly RSI, I would still maintain this ongoing bullish biasness for this mean reversion rebound to extend further on the US Wall Street 30. But given that it still can't break above our first resistance at 47,460, I do not want to tighten my short-term pivotal support to be so tight for today's Asia session low at 46,925. All right, over here. So still using the same pivotal support that we have yesterday, 46,585 for now, which is very close to the key 200-day moving average. Only breaking above 47,460. That also break out a minor descending channel resistance from the high of the 26th of February, and that could see a potential mean reversion extension to expose the next resistance level at 47,800, maximum 48,120. That confluence with the 11th of March minor swing high close to the downward sloping 20-day moving average, and also this dotted pink line, which is the former medium-term ascending channel support from 23rd May 2024 low that trigger a bearish reaction on 11th of March and now pullback resistance at 48,120. However, a price breakdown below 46,585 that would invalidate the extension of this mean reversion rebound and see further weakness to retest last Monday's swing low area, which is our pivotal support long term at 46,330. Breaking below 46,330 may increase the odds of a multi-week to multi-month downtrend phase for the US Wall Street 30 in the first step, exposing the next near-term support level at 45,780. Very close to the one-time Fibo extension of this ongoing corrective decline from the all-time high of 10th of February, and 45,780, if you look back graphically, is the minor swing low area of 21st of November last year. All right, so that's for the US Wall Street 30 representing the Dow Jones Industrial Average. Okay, next up will be the SPX 500. So the SPX 500 also rallied, hit our resistance level at 6,755. 6,775 yesterday. So price action during Asia session right now also showing a rebound from the Asia session low, which was also the former minor swing high on last Monday. Now turns into a pullback support at 6,717. So price action haven't break above 6,775. I do not want to tighten my pivotal support. So pivotal support will be at 6,675. 6,645, which is the 200-day moving average. Maintain this ongoing extension of this mean reversion rebound scenario, supporting by a series of higher low that is being flashed out on the hourly RSI as well. Next resistance above 6,775 will be 6,815, maximum 6,848. However, a bearish breakdown below 6,645 that would invalidate the mean reversion rebound scenario and see further weakness to revisit this last Monday swing low area and this Monday swing low area at 6,610, 6,585. So that's for the SPX. Next will be the Nasdaq 100. So Nasdaq 100 also rallied, hitting our first resistance level, 24,910, 24,960. So 24,960 is this medium-term descending channel or medium-term descending resistance taken from the high of the swing high of 28th of January this year. All right, so hourly RSI continues to flash out a series of higher low, right, indicating that momentum still remains intact. So with that, I will have a slightly adjusted upward pivotal support level, moving slightly from 24,470, which is very close to the 200-day moving average, to 24,710. Breaking above 24,960, we'll start to see this range resistance coming in at 25,107, 25,192, which is also confluence with the 50-day moving average. However, a price action breakdown below 24,710 that would invalidate the mean reversion rebound scenario to see a choppy downward drift again to retest 24,470, which is the 200-day moving average. Breaking below 24,470 will expose this Monday key minor swing low area at 24,350, 24,280 next. Right, so that's for the Nasdaq 100. Next up will be the commodities market, starting with gold. So gold continues to trade in a sideways range, very boring. So still remains the neutrality stance, and it's going to trap between the 20-day and the 50-day moving average, which is the upper limit and the lower limit of our neutrality zone. So still maintaining that neutrality stance between 5,125 and 4,960 for gold XAU/USD. All right, so next up will be the all important West Texas crude oil over here. So let me flash out the intraday chart, which is the hourly chart. So on the hourly chart, the West Texas crude oil continues to trade in a lower high over here, can't break above the 102.25 level. So if you look at the RSI, very obviously it now starts to slope downwards. Okay, over here, so indicating that lack of upside momentum. So with that, oops, sorry. So with that, I will have a tighten short-term pivotal resistance level, which is very close to this Monday high at 102.25. So this is very, given that this level here is very important, as long as it didn't surpass above 102.25 over here, it continues to trade sideways, but momentum starts to show clear signs of deterioration for the bulls over here. So potentially it could seek a retest at 92.60, breaking below 92.60 will expose 88.36 next. So still maintaining a bearish bias, but from a risk management perspective, I will tighten the short-term pivotal resistance, adjust it slightly downwards to 102.25, maintain a intraday bearish bias for this ongoing minor corrective pullback scenario to unfold. Two support level to watch, 92.60, below it exposes 88.36 over here. Only a breakdown below 88.36 will see a deeper minor corrective pullback towards 81.85, maximum 77.26/76.83, which confluence with the rising 20-day moving average. However, if price action starts to do a bullish U-turn from here and breaking above with hourly close above 102.25, this minor corrective pullback scenario will be invalidated, where the bullish impulsive upmove sequence will resume, retesting the current 4-year high, which was seen on 9th of March, Monday, a swing high area at 116.56/119.54 resistance zone in the first step. All right, so that sum up all the intraday technical outlook on the broad-based cross asset classes. So let's have a quick look at the economic calendar. What are the key data to take note of, other than today's key FOMC meeting, which I'll touch in a fair bit. All right, so today, 18th of March. So during the European session, there's this key ECB official speaking, ECB Machado at 4:40 p.m. Singapore time. Then we have the ECB core inflation rate finalized figure for February. That shouldn't be a big surprise, because usually the final and the preliminary figure more or less is in line. So the preliminary figure was at 2.4% year-on-year previously, higher than the January print of 2.2%. Then thereafter, you have this tier 2 inflation data up from US, 8:30 p.m. There'll be the core PPI data. So core PPI data is considered as factory gate prices. So for factory gate prices means the cost of, in general, the cost of doing business in US. All right. So core PPI for February year-on-year, 8:30 p.m. Singapore time. Market is expecting a slight uptick from January print of 3.6% to up by 1 basis point higher to 3.7% year-on-year. Then thereafter, we have the Bank of Canada interest rate decision for those who have interest in the dollar CAD and the CAD clauses. That will be at 9:45 p.m. Market participants expecting no change at 2.25%. Then all important will be the interest rate decision, FOMC. So for FOMC interest rate decision, market is expecting no change as well, 3.75%. But market will be paying very close attention to the FOMC economic projection, which is the dot plot releasing at the same time on 19th of March, 2 a.m. Singapore time. So this dot plot is very important because it will show what is the thinking of the Federal Reserve officials' forward monetary policy guidance in some way, as implied by their median projection for inflation trend, and most importantly, the level of the Fed funds rate over here. So let's take a look at previously what did the Fed projected in their previous dot plot. So the previous dot plot, right, was give me a minute now. Monetary policy meeting calendar. Right. So the previous dot plot was in 2025 December over here. All right, in the previous dot plot. Right. So they will do it in every 3 months. All right. So let's go to the December dot plot and take a look. All right. So this was a December 2025, and later at 2 a.m. will be the very first dot plot for this year 2026. So let's look at the December one. Okay, HTML. All right. So this was the December 10 dot plot, the last dot plot previously. All right. So let me expand my screen. So okay, so dot plot, right? They have the median one. So they will do projection for 2026, 2027, and 2028. All right, and also in the long run. All right. So if you look at GDP projection, what they did over here is that they upgraded GDP projection for US in the December dot plot away from the much higher than the September projection. So September projection for 2026 GDP growth was 1.8. So this year 2026 at 2.3%. All right. Then very important that given this ongoing US-Iran conflict, then we're talking about market pricing from oil has now indicating stagflation fear, and that also has been we call it expressed by that US Treasury yield curve bear flattening as well. So it will be very interesting to see whether would there be a downgrade of this GDP growth that was previously penciled in at 2.3% over here, and also the unemployment rate as well, which maintained at 4.4%. And you have the core PCE inflation trend at 2.5% previously, whether would there be an upgrade of it. If it does, that could potentially see the Fed funds rate to be higher as well. So the Fed funds rate, what they did over here for the December projection, by the end of 2026, they expected it to be at 3.4%. So given the fact that the Fed funds rate right now, the current rate is at this 3.5% to 3.75%. So at 3.4%, that only implies one interest rate cut over here. All right, so let's take a look at the CME Fed Watch 2. Okay. So this is the current market implied pricing by the Fed funds futures traders. All right, so for sure, right now, 18th of March, later, current rate is at 3.5% to 3.75%. So what the Federal Reserve dot plot previously is at 3.4%. So given 3.4 minus 3.75, the upper limit, so that's around 20 basis points. So it implies that the Federal Reserve on the median expectation, this is the median rate. If you take everything, the outlayer, everything you sum up together, the median Fed funds rate projection at the end of 2026, previously projected in December, was at 3.4%. So at that point in time in December, the Federal Reserve officials is only looking at one interest rate cut. So right now, if you look at the CME Fed Watch 2, for today, for sure, no cut, 98.9%, 98.9%, expecting the Fed to stand pat at 3.5%. But however, there's a slight 1% chance that the Fed will hike, which is a very outlier, with very low chance of 25 basis point hike, given by the pricing of the Fed funds futures contract. And if you look down the calendar, means further down the road for the next future Fed funds FOMC meeting, pardon me, we see it maintaining stand pat all the way until July. That means in the summer months, no interest rate cut coming in, and only in Q3, then potentially the first interest rate cut for this year will come, which in this ongoing interest rate cut cycle, the fourth interest rate cut will either come on the 16th of September or 28th of October. And market pricing by the last meeting of the FOMC meeting will be on 9th of December 2026, 92.89% chance that the Fed funds rate will be at 3.25% to 3.5%. So that is also implying one interest rate cut, and also in line with the previous dot plot projection of December, where FOMC officials, the median projection expected to be at 3.4%. So if this 3.4% is being reduced greatly to, let's say, at 3.2, reduced greatly, which is very unlikely. So it either will be at 3.4% given the current stagflation risk environment and the uncertainty surrounding the US-Iran conflict. But however, it's being increased upwards to, let's say, 3.7%. Right? That means that it implies that the Fed is not looking for any interest rate cut at all this year. If it's being increased upwards to more than 3.4%, let's say it's at 3.6 or 3.7%. So that will mean that, i.e., this Fed funds futures contract will start to adjust their expectation going forward in the next few months. That means all this probability of one interest rate cut in the Q3 of this year will be reduced greatly as well. So once that's happened, that could potentially see the dollar strength coming back into the picture during this situation at 2 a.m. Singapore time. So this will be the potential situation that could happen in doing this very short volatile movement. Then after that, we got to combat or decipher another volatility moving event will be how the Fed chair Powell. This will be, I think, his second last meeting before he passed the baton to Kelvin over here. Very likely it will be him. So his press conference will be half an hour later at 2:30 a.m. So during this press conference, market will be also very volatile as well, because market will actually dependent on how he express his view according to the various Q&A question that is being posed to him by the various media outlets, reporters. So that will be at 2:30 a.m. Singapore time, lasting until what I think about 45 minutes or so, around 3:15 a.m. Singapore time. So, all right. So that pretty much sum up today's daily dose of market insights. Kelvin here, signing off. Wishing you guys a great day ahead. And also do bear in mind that given such volatile movement, risk management is very, very paramount in such a trading environment. All right. So with that, have a great day, and we shall speak again tomorrow. Thank you.